Everyone talks about SCHD's yield, but that's not the real story. The real story is what's happening inside the fund, the actual companies driving your income, and what could change when Reconstitution hits. Because once a year, SCHD reshuffles the deck. Companies get removed, new ones get added, weights shift. And if you're relying on this ETF for retirement income, today we're breaking down what's really driving SCHD's performance, how the underlying holdings have performed, what Reconstitution actually does, and what it could mean for dividend investors going forward. Let's open it up, so stay tuned. Welcome back to Simply Money. Today we're doing something a little different. We're looking under the hood of SCHD. What's actually happening? And for those that are new to it, SCHD once a year does a reconstitution. Now every quarter they'll rebalance to make sure that all the funds and all the sectors are within the parameters of what they have set. But they also do once a year in March where they do a reconstitution, and that means companies that are not meeting the standards that have been set are removed and new ones are added based on the weightings that they have. We're going to look at some of the performance of the funds that are in there. Don't go away till you see the end where you see some of these differences, and then we're going to discuss what funds we think may be dropping off and which ones may be added. And we'll check it out after the March reconstitution to see how we did. But SCHD tracks the Dow Jones U.S. Dividend 100 Index. This is not a highest yield wins ETF. It screens for 10-year dividend history, strong free cash flow, return on equity, low debt levels, sustainable payout ratios. Then it weighs based on market capitalization, but modified so one company can't dominate the fund. This is quality dividend growth, not yield chasing, and that distinction matters. What's been driving SCHD's performance? Let's zoom out over the last couple years. Mega cap tech has dominated the market. Meanwhile, SCHD, which tilts forward, industrials, financials, energy, consumer staples, has not kept up with the high growth tech. But here's what's interesting. Even when price appreciation lagged, dividend growth continued. That means total return hasn't looked as weak as headlines suggest. If SCHD yields around 3.5% and grows its dividend 8 to 10% annually, over time that compounds aggressively, even if price growth isn't explosive. The key question, are the underlying companies still strong enough to support that growth? Well, let's look at the underlying companies and see what we have. We'll start right here by looking at some of the companies we have in there. We have Lockheed Martin, Chevron, ConocoPhillips, Verizon, Bristol Myers, Altria, Merck, Texas Instruments, Coca-Cola, and Pepsi. These are all companies you're probably familiar with. They're household names. And as you can see, nothing has over 5%. It's not overly concentrated. And they will continue to readjust this each quarter to make sure none of these take on too much. If one of them has explosive growth, it doesn't necessarily get too top heavy. And so you can see the top holdings here, they're all between 4.73% and 3.99%. You can also see in your sectors that no sector is overweighted. The highest weighted one is energy at just under 20%, consumer staples at 18.5%, healthcare at 16%, industrials at 12%. And look at this, technology, information technology, only 8%. So you're not getting that booming growth from the tech sector, but as value growth begins to take hold again, and as it shifts into energy and consumer staples sectors, you're going to see SCHD begin to blossom again. And we're beginning to see that in 2026 as it is up in the year to date about 14%. But I want you to look a little further at this. As we break this down into the chart, you can see these different companies. We have them listed over here. Down here, you can see the weighted percent that is held in SCHD. So again, the 4.36 and all these weighted amounts. As we come down to the bottom, these are all the companies inside of SCHD. You have some that are at the bottom, just like any fund. They take up just a very small percent, like Oxford Industries, only 0.01%. And the thing I want to draw your attention to is what's been happening this year as this fund has really begun to boom. You can see the top holdings. Look at the year-to-date return. 45% on Lockheed Martin, 22% on Chevron. We have Merck at 33%. And we're seeing these top companies. We only have one in the entire top companies here, which is Home Depot, which is only down 2.3%. That is why this fund is beginning to really take off, because its underlying funds are performing well. So we come down, we start seeing other companies that will probably begin to move up in the amount that they're holding. You have Valero and Ford at 50% growth this year. Then we have some companies that we see like Paychex down almost 39%, General Mills down 27%, but that is only less than 1% of the fund. I want to come down here a little further. You have Carmer LLT down 52%, but it's only less than 0.5% of the fund, so the impact is not as big as you see these top holdings and how well they've done. That's a look under the hood and what's been happening. And these are mature cash-generating businesses. They're not flashy, they're not speculative, but they're consistent. Now ask, which of these sectors have been hot lately? Energy had a strong cycle, financials have been volatile, consumer staples have been steady but not explosive. So SCHD's performance is tied directly to how these sectors rotate. This is why sometimes SCHD lags growth indexes, but shines during value rotations. What is this reconstitution that's going to take place? This is where things get interesting, because every year SCHD's index, it reevaluates all eligible dividend stocks, removes companies that no longer meet their criteria, adds companies that now qualify, and then adjusts the weights. This isn't a manager making emotional decisions, it's rules-based. If a company cuts its dividend, fails profitability screens, or falls below quality metrics, it's out. That's important, because SCHD doesn't wait for a disaster. It removes companies when fundamentals weaken. And that brings us to why reconstitution matters. If you're an income investor, here's what you should care about. 1, could yield change? Yes, slightly. If lower yield, higher growth companies enter, yield may dip, but growth potential rises. Secondly, could dividend growth improve? Possibly, if higher quality balance sheets replace weaker ones. And third, does it cause volatility? Sometimes short-term, rarely long-term damage. Historically, turnover inside SCHD has been modest. It's not flipping half the portfolio, but small changes compound over time. Let's look at an example. Let's say a company yields 5%, but with slowing earnings gets removed. It gets replaced with a 2.8% yielding company, growing earnings at 12%. Short term, yield dips slightly. Long term, dividend growth could accelerate. This is where many investors misunderstand SCHD. They look at yield today, not the trajectory. If you're retired and living off dividends, reconstitution could slightly alter income growth, slightly change sector exposure, and improve financial strength. But it does not turn SCHD into a high-yield covered call ETF. It remains a quality dividend growth core. That's very different from income maximizing strategies. This is where SCHD fits right now. In a market dominated by AI and mega-cap tech, SCHD looks boring. But boring generates cash flow, maintains profitability screens, avoids hype-driven bubbles. If we rotate into a value cycle, SCHD could look very different. If growth keeps dominating, it may lag price, but it still compounds income. Here's some final thoughts. The upcoming reconstitution is not something to fear. It's something to understand. The real question isn't, will yield change by 0.2%? It's, are the companies inside SCHD still the kind you want funding your retirement? Because once you understand what's under the hood, you stop chasing yield and start focusing on durability. If you own SCHD, tell me below, are you in it for yield, dividend growth, or total return? And what do you think Reconstitution will bring this year? Hit the like and subscribe button if you like these videos. If you found this helpful, it means a lot to us. And don't forget, throw in your comments down below. What companies do you think are out, and are there any you see on the horizon that you think might be in? Let's get some dialogue going on those comments, and I'll see what we do in the end of March when we recap this. We'll pull those comments out and see who had the most right answers on that. So I appreciate you joining me, and we'll see you next time on Simply Money.